All right, all right. So, have you ever placed a trade and you're really confident in that trade, and as soon as the trade is placed, after you put your stop loss in, the trade immediately goes to hit your stop loss, and then from the time it hits your stop loss, it goes straight to your take profit. I've been a victim of that time and time again. And the reason that that happens is that, everyone was taught how to trade in a certain way. And, everybody knows about like baby pips and looking at Forex patterns on Google when you first learn how to trade. So that's the base of most people's knowledge when it comes to trading. And through that knowledge is how the banks actually trap you and cause you to lose before the move that you knew that was already going to happen happens. And I'm going to show you with this. So if you look at this, this is Euro AUD. Let me zoom this out a little bit so everybody can see it. This is Euro AUD. One common way that you're taught to trade is you're taught to sell at the high and buy at the low, which is incorrect. But here's what happens: you see that these highs are relatively equal. So what's that saying is that every trader who's trading Euro AUD in the world right now, they see that this is a resistance. So a lot of people are going to be interested in selling right here. And what do people do when they place a trade? At least what you're supposed to do um, is to protect your account. So what a lot of traders will do, they'll place their sell here. That's where they place their sell. And then from the time they place their sell, they're going to put their stop loss anywhere between 20 to 40 pips in, to protect their account. And they're going to target the next level. They're going to target the next level down, which would be these equal lows here. So the person who's thinking of trading right here, their trade is going to look something like this. It's going to look something like this. We're going to do 30 pips. That's the average stop loss for most intraday traders. So from that point in time, you see that, this is another one. This is another one. You got a doji. A doji is commonly used as a point to where the market may reverse. So a lot of people are looking here. It's like, okay, I'm at an equal level of resistance. I have a doji, which is this candle here. This is going to be a great sell. So I'm going to place that trade. But let's see what happens after you place that trade. Let's see what happens. Everybody's confident. Everybody and their mama is trading this trade if they're looking at Euro AUD because that's what most people are taught. Just support and resistance, just basic support and resistance. It's worked a few times, so the person who's coming onto the market at this time thinks it's going to work again. But watch what's happened. It goes straight into your stop loss. This was supposed to be a reversal signal. This is supposed to be a place where the market respects. But who also knows about this stop loss is your broker, your banks. The people that are funding the broker are the banks. So what are the banks? The banks are also trading too. If you go up, look up Forex trading jobs, you're going to see Wells Fargo pop up. You're going to see Capital One pop up. You're going to see Amagi Bank pop up because the banks are actually have people that trade Forex for a job. And the way that the bank have to trade is they have to look for places where a lot of people are selling. And so they got to be selling when people are buying and buying when people are selling. So what happens when you place a sell trade? Well, you have your stop loss. And the banks can see this because your broker, if a lot of people's trading, certain brokers, that broker can see where everybody placed their stop loss. It's like an order. It's just like if you go to a restaurant and the restaurant has a certain number of people and everybody has to order, that kitchen knows what everybody ordered. The same thing goes with banks and the same thing goes with your broker. They know where you're trading, they know what you're trading. A lot of people are taught to trade this way. So an influx of sell orders came in at this level and an influx of stop losses came in anywhere around here. So this is what the bank has to do. If most people are going to sell here, does the bank have enough liquidity or is there enough space for a bank to get in at the market right here? No, because everybody else is selling here. There's nobody interested in buying right here. There's nobody. The other half of traders, the people that don't trade support resistance, they're breakout traders for the most part. And the breakout traders are going to place their limit. They're going to place their buy orders, their buy stops right here. So basically what they're saying is that as soon as price gets here, we know it's going to continue going up. So I'm going to place my buy stop here, and my trade is going to look something like this. So just to illustrate that, the breakout trade is going to look something like this. They're going to place it kind of below the next level, and they're going to shoot for the moon or whatever they want to shoot for. So now you have a seller who has a stop loss. A stop loss for a sell trade is a buy because they're buying their position back. And you have a buyer whose stop loss is a sell. So, but they're buying at this level. So you have your buyers are buying here and your sellers are buying here because that's where their stop loss is at. So the bank knows all of this. They see all of it. This is a common area. So what happens? They push the market up into this area on purpose. They push the market up into this area, and then they place their sell. And when they sell, it looks like this. It just goes straight in the direction that they want it to go in because they're the ones with the money. They're the ones that's trading billion-dollar accounts to make the markets move and to take billions of dollars in profit off of this move. But both traders are stopped out at this point in time. Both traders are stopped out. This is what happens with the bank trading. And I wanted to just come on here really quickly just to show you that not all Forex education is equal. You have to know exactly what the markets are doing. And if you really think back to, I guess, Warren Buffett's quote, you got to buy when people are fearful and sell when people are greedy. That happened with gold. If I go to gold real quick, everybody was talking about gold in this area. There was nobody that was selling gold here. There was nobody that was selling gold past 2000. Past 2000, it broke 2000. That was its all-time high. Nobody was selling gold, but the banks did. Everybody on Facebook was buying here, but the banks sold here. And a lot of people lost money off of that one move. This happened in a few hours. Basically, a few hours canceled out weeks of movement. That's what happens when the banks trade. And you want to learn to actually get into the markets when the banks are getting into markets so you can capitalize on the profits that the banks are making with the money that's in your bank account, because that's what the banks trade, is the money in your bank account. If you look at your terms and conditions, they'll say that they're going to be using the money for different investments meaning loans and trading. And what they trade, they don't necessarily trade stocks as much. They trade foreign exchange because they own money. So they trade the currencies to actually make money. So I hope you realize something here when it comes to trading, that, not everything is going to work, all of the time. But if you can find where the big boys are getting into the market, you can just trade along with them, and you can trade with the gravity of the market instead of against it. Y'all have a good one.